Welcome to the deep dive. We know how overwhelming the financial world can get. I mean, especially around earnings season, right?
Absolutely. It's a flood of information.
Exactly. So our job here is to cut through all that noise. Today, we're doing a deep dive into ServiceNow, ticker symbol NNOW.
A really interesting one, especially with all the talk about enterprise AI.
Precisely. They keep coming up as a company really shaping how large businesses use AI. So our mission is simple: give you a clear, concise, and, well, compelling understanding of ServiceNow right now.
And we've really dug into the sources for this one.
We sure have. We've got their latest financials, the earnings call transcripts, analyst reports, recent news, the whole stack, basically, to give you the complete picture.
Okay, so where should we start?
Let's ground ourselves. As we record this, ServiceNow, or NNOW, last closed at $968.79.
Got it. So ServiceNow itself, what exactly did they do for anyone maybe less familiar?
Good question.
Well, at its core, ServiceNow is an enterprise cloud computing company.
Hmm.
Think about a huge organization, right? Lots of departments, systems, workflows, often a bit messy, not always talking to each other.
The classic silo problem.
Exactly. ServiceNow comes in with its Now platform. It's like the central nervous system aiming to connect everything. It uses workflow automation, AI, machine learning, RPA.
Okay, so it's about making things run smoother.
Pretty much. Defining, structuring, managing, automating services across the whole business. Government, finance, healthcare, you name it. They help companies replace those old, fragmented systems with something smarter, more integrated.
And that efficiency, well, it usually shows up in the numbers. What are we seeing financially?
Yeah, the numbers are significant. Market cap is sitting around $201.5 billion. Enterprise value, TTM, is about $199.3 billion.
In the valuation metrics, PE ratio?
Right, the price to earnings.
Yeah.
It's definitely up there. TTM is 120.83. The forward PE is 57.43, and price to free cash flow is 52.35.
Okay, so 120 trailing PE. That immediately signals high growth, high expectations baked in. Investors are clearly betting big on the future here.
They absolutely are. And you have to ask, how do they sustain that confidence?
Yeah.
It comes down to what analysts call their wide economic moat.
Right, the competitive advantage. What's theirs built on?
It's really two things: significant switching costs and powerful intangible assets. Their platform isn't just software you install. It gets deeply woven into the fabric of a company. It becomes this extensible AI operating system for critical workflows.
Extensible AI operating system. Unpack that a bit.
Think about it. Employee data, customer service, IT support, supply chains.
Yeah.
So much of that can flow through ServiceNow. Pulling that out, it's like major surgery for the business. Hugely risky, expensive, disruptive.
So once they're in, they tend to stay in.
Exactly. That's the stickiness, and the numbers back it up. That 98% renewal rate is phenomenal. Plus, you see their biggest deals increasingly involve 5 or more products. They land and expand.
Makes sense. And that entrenchment, I imagine, really came through in their latest earnings report.
Oh, definitely. Let's talk about Q2 2025. They reported on July 23rd, and frankly, they knocked it out of the park. Strong execution, beat expectations significantly.
Okay, give us the highlights.
All right, so subscription revenues hit $3.113 billion. That's up 21.5% year over year in constant currency. Really strong growth.
21.5%. Wow. And the backlog, CRPO.
Same story. Current remaining performance obligations, or CRPO, reached $10.92 billion, also up 21.5% constant currency.
So that future revenue pipeline looks just as strong.
Exactly. It's a great forward indicator. Operationally, they're efficient too. Non-GAAP operating margin was 29.5%, and free cash flow margin 16.5%.
And customer deals. Any color there?
Yeah, lots. They closed 89 deals worth over $1 million in new annual contract value. And interestingly, all of their top 20 biggest deals included 5 or more products.
There's that expansion again.
Right. Plus, that 98% renewal rate held firm. And the number of customers spending $20 million or more with them annually, that jumped over 30% year over year. Big commitment from big clients.
These are stellar numbers, no doubt. How much of this is tied directly to that AI strategy you mentioned earlier? Is it just good selling, or is AI the core driver here?
It's absolutely tied, and I'd say it's becoming the core driver. Their whole positioning now is around being this extensible AI operating system for the agentic enterprise.
Agentic enterprise.
Yeah.
Meaning AI that takes action.
Precisely. AI that doesn't just analyze but does things. Starts workflows, resolves issues, makes approvals, autonomously. ServiceNow wants to be the platform where these AI agents work.
And the Now Assist product suite fits in here.
Exactly. That's their flagship AI offering. It consistently beat expectations in Q2. Deal volume, deal size, both up significantly. Products like ITSM Plus and CSM Plus, they quadrupled their deal value year over year.
Quadrupled. Wow. So those are the AI-enhanced versions of their core IT and customer service tools?
Yes. The pluses means deep AI integration, automated routing, predicting issues, smart virtual agents. It's not just bolting on AI, it's rebuilding processes around AI for real productivity gains. That's a powerful sell.
Okay, so they're clearly executing well and innovating, but the market always wants to know what's next. What are they doing strategically to keep this momentum going?
Good question. They're making several key moves. First, the acquisition of Data.World, which just closed in July.
Data.world. What does that bring?
Better data governance and intelligence. For that agentic AI to work reliably, it needs clean, trustworthy, accessible data. Data.World helps embed that capability right into the platform, making the AI smarter and safer, basically.
Makes sense. What else?
Well, they're seeing rapid growth in CPQ configure price. Quote, after buying Logic.ai, closed 9 deals in June alone. They're also advancing their own LLM, Nematron, with NVIDIA.
Ah, building their own foundational model, not just relying on others.
Seems that way. Probably aiming for something more tailored and secure for enterprise tasks. Plus, partnerships with AWS, UKG, Cisco, expanding the ecosystem. And this now Next AI program.
What's that?
They actually send their engineers to customer sites to speed up AI adoption. Hands-on help to get value quickly.
That's quite proactive. So, given all these moves and that strong Q2, what are they telling the market about the future? What's the guidance?
They've raised their full year 2025 guidance. They now expect subscription revenue between $12.775 billion and $12.795 billion.
And the growth rate on that.
That's 19.5% to 20% constant currency growth, which is still very robust for a company this size.
And longer term.
Ambitious targets. Over $15 billion in subscription revenue by 2026, and they want $1 billion just from Now Assist ACV by then.
$1 billion from Now Assist alone. Okay.
Yeah, and they mentioned a huge pipeline, over $1.2 billion just from their recent Knowledge 2025 event. Plus, the average deal size for new customers is up over 100% year over year. That signals strong future potential.
Okay, impressive growth story, ambitious plans.
But this does raise the important question, right? With all this positive momentum, what are the potential bumps in the road? What are the concerns?
Yeah, let's get into the bull versus bear debate. Always important. Let's start with the bulls. What's the optimistic case here? Why are investors excited?
The bull case is pretty compelling, I think. First, that dominant position is the agentic AI operating system. Unifying tech stacks, driving productivity. That's a powerful narrative. They become essential.
Right, solving real business problems.
Second, just the raw performance. Strong financials, consistently beating guidance, that builds trust. Third, the innovation pipeline acquisitions, partnerships like we discussed, they're staying ahead.
Okay.
Fourth, customer expansion. That land and expand model is clearly working, shown by those multi-product deals and renewal rates. They get stickier over time.
And the last point.
This is maybe the most strategic point. Reinvesting internal AI savings. Instead of just boosting margins right now, they're plowing those efficiency gains back into growth, hiring more sales, more engineers, doubling down on AI R&D.
So, playing the long game, prioritizing market share over immediate profit bumps.
Exactly. Bulls see that as smart capital deployment, a sign of confidence in capturing this massive AI wave. It's a big bet on the future.
Okay, that's a strong bull case. But that valuation we talked about, that high PE, that implies near perfect execution.
It really does.
So what could go wrong? What are the bears worried about? What are the potential headwinds?
Right. The bear case, number one, is absolutely that valuation. It's high. The stock's trading a bit above fair value estimates, less room for error. Some investors might want faster margin expansion than this reinvestment strategy allows.
Okay, valuation pressure. What else?
Market headwinds. Specifically, the U.S. federal market looks cautious due to budget tightening. Management factored it in, which is prudent, but it's still a potential drag.
A specific sector risk.
Yes. Then there's reliance on AI adoption continuing at this pace. And competition. Other big enterprise players are jumping into AI workflows too. ServiceNow has a moat, but it's not impenetrable forever.
Competition could heat up.
It could. Also, acquisition risk. Integrating companies like Data.World needs to go smoothly. And that pending MoveWorks deal, it's not even in the current guidance. If that closes later this year, management warned it could create potential margin headwinds.
Ah, so an unknown variable there.
Exactly. And finally, those ambitious targets require flawless execution. Any slip-up, any missed quarter could really hit the stock hard given the high expectations.
Okay, so a clear set of risks to balance the opportunity. Let's circle back to the price then. Where does all this leave us?
Well, as you said, last close was $968.79. The fair value estimate from our sources is around $989.86, so pretty close. The company's internal target is higher, $1.01K.
And broader analyst consensus.
The average analyst price target over the last 6 months is about $13.20. So analysts generally still see some upside from the current price.
All right, so wrapping up our deep dive today. ServiceNow delivered a really strong Q2, beat expectations, and showed its strategy around being that agentic AI operating system is gaining traction.
Definitely. Now, Assist is clearly a key growth driver, pulling larger multi-product deals.
Right. But they face ambitious targets, a high valuation, and some potential headwinds like the federal market and integration risks. And that strategic choice to reinvest for growth instead of boosting margins now is a key thing to watch.
It really frames the whole investment thesis, I think.
It does. Which leads us to our final thought for you, the listener. Considering ServiceNow's decision to pour those AI savings back into growth, delaying maybe some short-term margin gains, what stands out to you about that long-term strategy in this incredibly fast-moving AI world? Is it visionary boldness or maybe unnecessary risk? Something to mull over.
The great question to ponder.
And if you found this deep dive valuable, please do subscribe to our channel and hit that notification bell. It really is the best way to support us, and it ensures you won't miss future deep dives that can give you the insights you need to be truly well-informed.